All right, let's get right into this. Welcome to the explainer that is basically going to be your ultimate locker room pep talk and insider cheat sheet. If you're gearing up to sit right across from the LIC Housing Finance panel for the junior assistant role, well, you are in exactly the right place. Today, we're taking this massive mountain of financial jargon and corporate facts, and we're turning it into a super clear, easy-to-follow roadmap. We are going to decode exactly what that panel wants to hear, so you can walk into that interview room with just absolute, undeniable confidence. To get you there, we'll be tackling 5 core pillars today. We'll start with knowing LIC housing finance, then look at the core business of home loans, touch on the RBI, KYC, and CIBIL, figure out managing risks with NPAs, and wrap up with your role as junior assistant. Starting off with Pillar 1. Know LIC housing finance, the macro view. Okay, so these foundational facts right here, these are your guaranteed icebreaker questions for sure. You're going to want to commit these exactly to memory. LIC HFL was established on the 19th of June, 1989, and it's headquartered in Mumbai. You absolutely must know the leadership too. Shri T. Adhikari is the MD and CEO, and Shri Doraiswamy Ramachandran is the chairman. Oh, and whatever you do, do not forget their iconic tagline, Kar Ki Baat. Being able to rapid-fire these names and dates accurately, it instantly shows the panel you've done your homework. Now, this builds to one of the most common trick questions that loves to pop up in these interviews. The panel will lean in and ask, so, is LIC HFL a bank? Let me tell you, answering this one incorrectly is a massive red flag. The critical distinction you need to make is that, no, LIC HFL is absolutely not a bank. It's a housing finance company, or an HFC. See, traditional banks offer this huge umbrella of services, savings accounts, current accounts, all sorts of completely unrelated loans. An HFC, on the other hand, specializes specifically in housing loans and real estate products. It's also super important to mention that LIC HFL is a public limited company that's regulated by the Reserve Bank of India, not a government entity. Moving right along to Pillar 2, the core business, home loans, understanding the products. All right, let's open up the toolkit. These are the tools of the trade you'll be working with every day. LIC HFL doesn't just hand out some generic home loan. They offer a whole suite of specialized products. You've got your standard loans for constructing or extending a home, and then plot loans, which, fun fact, actually carry a higher rate of interest because buying just a plot is often viewed more as an investment. Then you have top-up loans, which let a customer literally top up their existing loan to pay for things like interior work, and balance transfers, which are a highly competitive tool used to move a customer's existing loan from some other bank over to LIC HFL to get them a better interest rate. Now, one very specific product you definitely need to wrap your head around is the composite home loan. Interviewers absolutely love asking candidates to explain how this differs from a standard loan. Just think of it like a 2-in-1 combo deal. It's literally one single loan that finances both the initial purchase of the plot of land and then the subsequent construction of the house on that very same land. It simplifies the whole process for the borrower immensely. Now, any loan out there is paid back via EMIs, equated monthly installments, right? That's principal plus interest. But how exactly is that interest calculated? Well, you need to be able to explain this to a hypothetical customer as if you're already on the job. A fixed interest rate just remains constant, meaning the customer gets a perfectly stable EMI, which is great if you think overall market rates are about to shoot up. But a floating interest rate, that varies with the market. It swims with the economic current. If rates change, either the customer's EMI amount changes or the whole tenure of their loan extends. That's the best strategy when you expect market rates to drop. Next up, Pillar 3, RBI, KYC, and CIBL, the regulatory landscape. Before you can enforce the rules, you gotta know the rule maker. If we take a quick look at the history, there are a few vital RBI milestones that constantly pop up in these banking interviews. The RBI Act was passed in 1934. The bank itself was officially established on April 1, 1935, with an initial capital of 5 crore, and it was officially nationalized on January 1, 1949. If you can recite those dates flawlessly, you immediately establish a super solid baseline of financial literacy with the panel. Now, how do banks systematically protect themselves? KYC. Know your customer. You have to understand that this isn't just boring paperwork. It's a literal fraud mitigation strategy. Customers are bucketed into 3 distinct risk categories. You've got low-risk customers, like standard salaried individuals, who only need their KYC updated every 10 years. Medium-risk customers, like businessmen with really high transaction volumes, get updated every 8 years. But high-risk accounts, we're talking politically exposed persons, NGOs, or potential shell companies, they must be aggressively verified every 2 years to prevent money laundering. To actually perform that KYC, there are 6 officially valid documents, or OVDs, that are recognized by the RBI for digital and central KYC. You've got the passport, driving license, voter ID, Aadhaar card, NRGA job card, and the National Population Register letter. Okay, listen very closely here, because this is a trap that panels love to set for candidates. The PAN card is officially not considered an OVD by the RBI. If they ask you to list OVDs, explicitly telling them that you know the PAN card is excluded, man, that will earn you massive bonus points. 750. That is the absolute magic number when it comes to a good CIBIL score. These scores range from 300 to 900, and as a potential employee, looking at this metric is how you'll quickly judge a borrower's past repayment discipline. Anything sitting above 750 basically screams to the lender, hey, this person is highly responsible with their money. All right, Pillar 4, managing risks, NPAs, when loans go bad. You really need to memorize the exact technical definition of an NPA, or non-performing asset, verbatim. It is a loan or advance where the principal or interest payment remains overdue for a period of 90 consecutive days. That 90-day threshold is absolutely crucial. That is the exact moment an asset officially stops generating income for the bank and turns into a total liability. And a bad loan, progressive degrades over time. Hitting that 90-day mark makes it an NPA. For the next 12 months after that, it's classified as a substandard asset. Between 12 to 24 months, it downgrades even further into a doubtful asset, meaning recovery is highly suspicious at this point. Finally, if external auditors come in and determine the money is completely unrecoverable, say because the collateral documents were totally forged, it gets declared a loss asset, and the bank literally just has to write it off. But hey, banks don't just give up and walk away. Let's open up the recovery toolkit and demystify some of this really heavy jargon. First up is the Sarface Act. This is basically a legal bypass that lets the lender auction off the collateral without having to wait around for court intervention. Then you have ARCs, asset reconstruction companies. Think of them as buyers of bad apples. Banks will sell off their NPAs to ARCs at a steep discount just to clean up their own balance sheets. Finally, the DRT, the Debt Recovery Tribunal, which is a specialized legal body that steps in and gives the defaulting borrower a strict 45-day time frame to settle their dues before drastic action happens. Of course, the absolute best way to manage risk is right at the starting line, through margin money and LTV. You've got to remind the panel that LIC HFL almost never finances 100% of a property. The borrower has to have some skin in the game, right? That's the margin money, their down payment. The remaining percentage that the lender actually provides is completely governed by strict loan-to-value or LTV ratio policies. Which brings us to our final stop, Pillar 5, your role as junior assistant, the day-to-day reality. So, what are you actually going to be doing all day if you win this seat? Well, your responsibilities will include assisting customers with their loan applications, meticulously performing all that KYC and document verification we talked about, handling vital financial transactions and data entry, and supporting the senior officers and branch managers. You really need to validate to the panel that you understand this role isn't just sitting around thinking about high-level finance. It is heavily clerical, it is customer-facing, and it is literally the operational backbone of the LIC HFL branch. And this leads us to a perfect model answer for the inevitable interview question, so why should we hire you? Please, don't just tell them you work hard. Everyone says that. Connect your specific traits to their specific everyday needs. Highlight how your background has strengthened your analytical skills and your accuracy, which directly translates to you processing those loan applications flawlessly. Frame yourself as detail-oriented for the document verification and approachable for the customer service side of things. So the big question is, are you ready to claim your seat on the LIC HFL team? Look, you now have the ultimate mental cheat sheet. You know the company, you know the specific products, the intricate regulations, the risks, and exactly where you fit into this giant puzzle. All you got to do now is take a deep breath, trust the preparation you've put in, and walk into that room ready to absolutely dominate the panel. But I want to leave you with one final thought to ponder. Once you actually master this junior assistant role and get your foot in the door, is this just going to be a job for you, or is it going to be the foundation of a lifelong career in the massive, fast-paced world of Indian finance? Well, that is entirely up to you.